Crane report. A for accounting quality. Material accounting policies. Mahindra's analytics. This page is corporate governance architecture. In this page, accounting quality, part of the accounting quality, I am bringing the distinction between the material accounting policies as stated by each and every annual report of big companies and the corporate governance aspect of it, of accounting policies. What we are looking at is two different things. Accounting is object oriented, transactional, and quantitative, and object governance is used. Accountability is subject oriented, non-transactional, and qualitative, and subject governance is used. Extended to the society, self-governance is used. If you look at the one major area which I have put here, let me quote from OECD, one of those papers. The big four accounting firms participating in consultation paper review of the OECD instruments on combating bribery of foreign public officials in international business transactions 10 years after adoption, said it is management's responsibility, with oversight of those charged with governance, to ensure that the entity's operations are conducted in accordance with laws and regulations. The responsibility for the prevention and detection of non-compliance rests with the management. I seem to agree with that at this point of time. But accounting firms, accounting profession has to go a long way in complying with the corporate governance aspect of it. If you look at that, one of the areas which had been indicated here is intangible assets. In intangible assets, as I explained previously in risk management, is an oxymoron. And that IAS 38 intangible assets, I recommended it must be scrapped. If you look at that IAS 38, which offers a definition of intangible assets, an intangible asset is an identifiable non-monetary asset without physical substance. In risk management, it was considered as an object, and so I explained intangible asset as an object. In this page, it is corporate governance we are looking at, the accountability factors concerning the intangible assets. That is the distinction I would like to emphasize at this point. Please take a look. If you look at that, what M&M's annual report has been mentioning, the other intangible assets are amortized over the estimated period of benefits as below. Asset class is development expenditure, 3 to 5 years, software expenditure, 3 to 10 years, brand license fee and trademarks, 6 to 30 years, technical know-how, 3 to 10 years, and others, excluding transferable development rights, 2 to 30 years. When we look at these asset class, development expenditure, software expenditure, brand license fee and trademarks, technical know-how, and others, it is related to, for example, the patent or software expenditure, high priced items like SAP and all that, brand license fees, technical know-how, which is efficient within the company's expertise. So we are looking at the people who are totally diverse in different areas of experience and development within a company. It is not for the CFOs or the big accounting firms, as they said earlier, is the responsibility of the management. So when such a diverse area of experience is coming from a particular company, it is the management which has to take cognizance of who the person's responsible and who the person has to be trusted upon to develop these assets, asset class. I'm not here telling it is intangible asset or that sort of a thing. It is an asset class, it is a R&D development that is happening around. And for example, the brand value totally could be from the marketing people who are pushing it. So this area we have to be very carefully look into the corporate governance aspect of it and how the subject oriented. Who are the people? These are the people have to be identified. If the auditors do not take the responsibility for this development on corporate governance, it's up to them. It's not needed. They go by a true and fair view of what they do on the transactional, object oriented, quantitative governance aspects, what is being done or not. That ends the matter. So, corporate governance has to be brought in the accountability of these areas where non-monetary areas are being looked into as an asset without physical substance, and the responsibility must be taken by the management. And this is the basic principle I would like to emphasize on the corporate governance architecture. Some more examples here on accountability, differentiating between accounting and accountability. For example, the case of revenue recognition. We normally see in auditors' reports, final reports, true and fair view in conformity with the accounting principles generally accepted in India. True and fair view is good enough for a sale of goods. Sale of goods for a company like M&M is about 150,000 crores. Daily is about nearly more than 300 crores. So is the case with Adani's or Reliance. Is an amazing number of sales that happens. So they can take under true and fair view, provide that information in such a manner. They do the auditing aspect of it in the best possible manner. That ends. But in corporate governance, you cannot apply the same statement. In corporate governance, we are looking at the accountability of a number of people within a particular company, whether it is marketing and sale of goods and services, or if dividend or interest income coming from a different area of investment, or if you look at the income from financial services, if you look at the property development activity, they are all different people, different department. When you look at the recognition of employee benefits, comes from possibly HR, Superannuation Fund, ESIC, Labour Welfare Fund, Provident Fund, Gratuity Long-Term Compensated. Like that, we have the whole department is looking at a particular process area. These process areas are being looked after in terms of accountability of a team of people of five. One of the ethical responsibility and the four fiscal responsibility. And there can be any number of teams that are working under for these areas. So in accountability, which is non-transactional, qualitative, and subject governance is used. Self-governance comes later. This is the one which we have to be very clear about it, differentiating between the auditing aspect of it, statutory auditors, and I would like to tell the same thing at this point of time. When I saw the this thing for the PSBs, SEAs and SBAs, statutory central auditors, statutory branch auditors, certain things had been given by ICAI as to guide them, the guidance note being given, how to audit on the corporate governance. I would like them to take a look at what we have been referring here in the various aspects of corporate governance. And one thing is your statutory audit, another thing is corporate governance audit, and these are two different domains. And what we have to come out is how accountable each person, each team in each and every area of transaction that we are looking at in different departments. Likewise, there are 47 process blocks that have been indicated, which are crucial and critical for Viksit Bharat 2047. When we talk of business combinations, acquisition of interest in associate and joint ventures, non-current assets held for sale, hyperinflationary economies, which have been indicated here as material accounting policies. It had to be taken in terms of the individuals who are manning it. It's a management decision making process. That's what we show here in Act 7 activity by resource area of what the management, particularly ethical area, which is if you go to look into the futuristic area of Viksit Bharat 2047, where are all these people? I call them as the ethical assets of the company. And that is captured in this Index 7 activity by resource area. AR management, ethical responsibility, fiscal responsibility, the managerial force, operating force, technology, finance, and together each team brings about the excellence and competing with each other. If there are 26,000 people working for a company, every one of the teams divide 26,000 divided by 5, make a team, and going towards a target possibly on 2030 planning, strategy plan 2030, or for going towards Viksit Bharat 2047. These are the people who have to be brought into fore as change in the structure which may be necessitated as and when a company goes toward a target of 2047. It could be anything. Today is 150,000 crores for turnover. It could be about 1.5 million or billion or trillion. We don't know. This is what these the people are the one who are going to decide. What we have discussed so far and a CREAM report. CREAM is for corporate governance, risk management, earnings, accounting quality, and management quality. And the management quality, we have about board of directors, summary of committees, vigil mechanism, looks into the maintaining ethical business standards, commitment to business associates, suppliers, customers, and the environment. We are just discussing in this particular episode material accounting policies, and we had discussed about risk management, water security, carbon emissions, product stewardship, health and safety, and sustainable supply chain, and as well as the internal controls COSO framework, totaling about 296 process blocks. These are the standards. The total points is about 7,400 in terms of ratings. That will be into 296 into 5 into 5. When you have about these process blocks, they are the standards, SOS governance standards, which had been given here as a guidance for the purpose of verification as to how it is being these are the rules which are being put through and how the conduct comes into the being, the conduct of the people. Then we have an excellent super corporate governance. Corporate governance is after all these 296 process blocks being measured, how the conduct is being done by each and every individual, by several teams which had been put through in a single company. And then E for earnings. The E for earnings, which I shall be coming out in my next episode, is in terms of M&M here I may include Reliance also, purely out of what it has happened, what they have done in for the last about 4 years, and that without the assessment of these 296 process blocks on management quality, vigil mechanism, etc. These are the standards are there. How the standards and how the earnings are coming to. These standards, verification of the corporate governance of these 296 open-ended process blocks or the standards and how it is being conducted individual will relate as a raw material for your earnings. The earnings part of it when we are going to do the next one, please wait for it. I'll come out in a couple of days time. Combined with that is a corporate governance, and that when we extend to 2030 will enable the companies to take it to 2030 and how they want to do based on what they have already corporate governance they have already done for the last 4 years, and then extend to Viksit Bharat 2047. So it's a challenge for every company. Some of them could be doing very well, and it's a decision making process of the various policies. That's what the board has to take note of it, mainly of the policies, and we have also taken into account the practices, which is that of the CEO and workforce, and also the people, which is that of the society. That is how the corporate atomic structure has been structured. So wait for me on another couple of days. I'll let you have how they have functioned in the last 4 years, M&M, and how they could move forward. FEC reports Fiscal and Ethical Co-Responsibility Framework provides with the subject-object self-SOS governance standards, how they are collated and brought into a governance standard. This is very significant in terms of understanding that no single task is being entrusted to a single person. Then the governance is not possible. It has to be seen together as a team, as we have indicated here, of 5 members in this particular team. One single team is good enough for the FSA report to be created. And if you extend it to the whole company, you have any number of sectors individually collated, individually measured, each team, how they have done, matter energy part of it being put through. And the company can be brought into the FSA report. No problem on that. And in addition, if you really look at it, extend it as what the universe does. After all, universe has got more number of objects than what a single company has. It can be extended to the entire GDP working part of it. There's a beauty of this particular report based on the corporate atomic structure with a return on intangible on how the energy force works within a company, within a particular team of each member, and how the matter is being shifted from one space to the other. It's as simple as that.